good afternoon, everyone. For those ones that are actually based in Australia, welcome to this week's webinar. We've got special guests with us for this week, and I would just like to do a small introduction, introduce myself. My name is Zoran. I'm the Senior Premium Client Manager here at Pepperstone, looking after the high net worth individuals and clients like Stacey Burke. We've got a guest tonight as well, Stacey Burke. Stacey is an experienced trader, trading the markets for a number of years, and he will be talking about his strategies ahead of the US election. Please welcome him. And lastly, I've got the head of research at Pepperstone and finance guru. He's been working for multiple banks around the world and London, Weston. So welcome to this week's webinar, guys. Just very quickly, how's a couple of things for the night. So for those that actually signed up through Stacey Burke's link and would like to take a full advantage of the special offer that we have available, please reply back to Stacey or click on the link that is got available to actually become a Pepperstone client. For those ones that are actually already clients of Pepperstone and would like to take a full advantage of our offerings as well that we have exclusively for you, feel free to reply to the email that we've actually sent through to you over the last few days, and we will make sure to look after you. So off to you, Chris Weston, and thank you, Stacey, once again for coming and attending the webinar.
Well, where's Stacey's whiteboard? We're getting one question from Perry. Stacey, where's your whiteboard? Looks like the opposite of the whiteboard behind you there. Some pretty funky art. Professionally speaking, trading the US election. Actually, we're going to go a little bit off topic. It's not just going to be about the US election. Stacey's a big fan of trading the pound, and being a Pom, I've had a vested interest in Brexit for some years. It's been frustrating, as I'm sure everyone else has attested to. I'm sure my son doesn't walk in any moment now. So I thought we'd just touch on what's going on in the pound as well, because actually, if you look at the flow going through the desk at the moment, there's been some huge volume in the pound. So I thought we'd just touch on that, and maybe touch on the Aussie today as well, because what we saw today from the Reserve Bank of Australia, from Governor Lowe, suggests that we're going to get a fairly punchy November meeting. How much of it's priced in, and what can they do about trying to lower the Aussie dollar? That might be something we can touch on. But the crux of this will be around the US election, because it's starting to get deafening now in terms of the noise around what's going on there. The market is really focused on not just what's happening about Trump versus Biden, but also, to a lesser extent, the House, and definitely the Senate as well. Will there be a vote that causes volatility on the day? When do we get a result, and how do we trade there? So Stacey and myself are getting together. We've both got incredibly different styles. I'm more sort of global macro. We'll go through Stacey's situation and his trading style in a moment. Very, very different from mine, and hopefully they can complement each other very well. I will just quickly touch on the disclaimer for compliance purposes, just to let you know that everything that we say today is general in nature. Please do not consider this as personal advice. If we do happen to give any kind of recommendations, please don't feel that we've considered your circumstances and our own opinions. So that is good to go. All right, Stacey, let's have a little chat about how the markets are treating you. We are coming into the US election. We've gone, the markets have thrown up incredible surprises this year. Obviously, we've got over what happened in February, March, and we've seen that sort of complete grind in equity prices, and they're sort of plateaued a little bit now. And obviously, we've gone through COVID. We're starting to see cases starting to rise up in the UK, Europe, and parts of America as well. We're getting over it to an extent in Australia. The pound's been pretty whippy. I know that's one of your favourites, but how's the trading been treating you so far in recent times?
First of all, Chris, just want to say thanks to Zoran and yourself for having me, and just appreciate you guys, and you look after me, and I appreciate that. So thanks for having me on.
Pleasure.
Well, one thing about the pound, the reason I like it is because it moves, and the last few months, obviously during COVID and everything, we had an immense amount of volatility, and that's sort of stabilized. But for the most part, I think we're sitting at a tipping point where When we look at the longer term charts, obviously we're going to get into that, but I think that the upside on the pound is pretty big. And I think even though I'm on a shorter time frame in terms of day-to-day stuff, as we talked about the other day, I try to align that with the overall underlying trend. And I always feel like the pound never disappoints. There's always, consistent movement in each session. Obviously, not some sessions may move better, but generally speaking, London and New York tend to move very consistently, which is one of the other reasons I like trading the pound. And in terms of volatility around these coming events, I think the big thing is whether or not the volatility will make it untradeable in terms of the spreads widening and some of the spiking and that sort of thing, as opposed to the stable, if that makes sense. And I'm looking forward to hopefully some bigger trends developing, because obviously that will help to, I guess, create some opportunities with the intraday stuff as well. And as we talked about, as much as I am short term, I try to align that with the bigger picture. If that's where the big money or the smart money is moving things, we want to piggyback on what they're doing.
Yeah, I just want to bring up this chart. So I think you just touched on something that we thought was quite good, quite interesting, the characteristics of the market. And I've got this map now. This is cable over the last month, and what I've done is I've broken it up into the individual sessions. So you can see this orange one. Let me actually see if I can change that to make it a little bit more color friendly. Spare me a sec. Can you see my screen?
Yeah, perfectly.
Let's go for a little bit of red here. So I just like your point here, because I think it's really important, and you can see the ranges. So the red rectangle is the New York session. The green one there is London, and you've got blue, which is Asia, Tokyo and Australia. And you can see that the ranges generally are far smaller. I guess that's a function that when we get Brexit news, most of that comes out during sort of European, US trade. And also you get, on the dollar side, you get the big announcements, payrolls, whatever it's going to be, a Fed speaker coming out through US trade. You can see the range expansions coming through. And if you like range, if you like movement, then you're really going to get that in sort of that crossover period between European into London trade. So is that what works for your strategy? Is that what you're looking for? You're looking for those extended ranges. Does your strategy not work? On the second question, does your strategy work less well when you get tighter ranges within the market?
Well, generally speaking, as the day evolves, Asia will typically, anything can happen on any day, but there will usually be a high and a low. And I like to focus on the round numbers, the 50 levels, the double zeros. As Asia heads into London, as we're looking today, we'll go through that in a minute. They are trading around 130 just on the pound, but London will usually expand the range. If not, like yesterday, we saw them take the range down lower before they put the low of the day in. And typically, if Asia's sort of the consolidated sideways range, London will put in one of the extremes, and New York will often lock in the other. So timing wise, how they open the market is important to me, because they'll often, they'll be looking to potentially take, traders in the wrong direction before they lock it in and possibly reverse it, or come back into the Asian range and then take it out, trapping them maybe in the wrong way, and then shifting the market. So I sort of, I guess maybe to some degree, I'm a contrarian. I'm always skeptical about price and watching, I guess, the timings of everything, the clock. I have a window of timing based around the open that I watch, and then of course the number levels in terms of them extending the range out to a 50% level or a double zero level, and then looking to see how price behaves at the.
Let's make you a presenter. Let's go to your strategy, because I know that some of the guys in the room will be quite au fait with what you do, but there's also going to be a lot of people who are listening to this and going, tell me more. Are you all right if I make you a presenter and you can actually show people how this works in practice?
Certainly.
Right, you should see that now coming through to
Yep.
grab. Can you? Yeah.
Okay,
cool.
so can you see that chart?
Yes, mate. All good.
Okay, so is that clear, Chris, for you guys?
Yeah, can you put it on full, is it on full screen?
Yeah,
It
that's
is,
full
that's
screen.
fine.
Is that
Yeah.
not, is that big
Okay,
enough? I
that's
can
good.
probably.
Yeah, that's good. That's good, yeah.
Okay, so just on that, I was mentioning earlier about the longer term. This is a monthly chart of the pound. And of course, like I've only got the chart going back to 97 here, but you can see that we're down pretty much at 25 year lows. And obviously there's plenty of upside. So as I was saying earlier, I think that obviously the downside seems to be sort of less likely depending on the outcome of Brexit. And just looking at the shorter term charts, just bring up the pound here in a second. Get this.
So you've done something similar here as well. You've broken up. Have you broken this into sessions, or those color bits? They mean something in terms of like a candle, candle pattern or something.
Can I? Is this is that little box showing in the corner, or is that in the way? I can't.
It all looks good. It looks fine.
You can see the chart?
Yeah, absolutely.
I'll just close this window. Okay. So I got to get this out of the way. I can't see the box is in the way. Okay. Sorry. Okay. Sorry.
So take some.
All right. So yeah, there we go. Okay. So the colored box, I've only got the equities hour on there, and effectively, so the blue again is Asia, pink is the London hour, and then yellow is the New York session for the equities hour itself. And can you see the number levels on there, Chris?
I can see them on the
Dark
right
line
hand
is
side.
the
Yeah.
double zeros.
Yeah, that's
Yeah,
fine.
the dark line is the double zeros. We got 50, and then of course the quarters in between. But typically, yesterday was a textbook example of the consolidation coming from the close of the session the night before. The dotted line is the rollover at 5 p.m. New York.
Yeah.
Asia puts a high and a low in place, and then of course they break out towards the last part of the Asian session. In that pre-market hour, they take it another 25 pips lower below the double zeros. The pound tends to really love trading from double zeros and 50s. And again, that first half hour, they put a high and a low in place, and they lock it in and go sideways, and then come back the other way. We had a nice fast 75 pip stop hunt, and then a continuation. So typically what I'm looking for each day is how the market sets up in the Asian session, what number levels we're trading off of, and then how they open the market in London. Are they taking us, are we up high in the week in terms of the Monday to Friday cycle? Are they taking us down inside of the range or up outside towards the highs of the week and the high of the day, that sort of scenario? And if they are, what time is it? Are they taking us up there and then consolidating for a fast move back inside of the range? And again, basically, we're looking at a 25 pip sort of high-low range, and then a 50 pip stop hunt sort of to the other side. And yeah, like today we saw, they run the 25 pip box. They went up to the high towards the end of the Asian session. They've come back down and consolidated, and they put the little, at the open of London, I'll blow this up a bit. They've just put that little pin and that false sort of swing long in the first 3 candles. So again, the hour usually gives the high and the low for the London session, and then they'll typically trade off of one side or the other. So they've gone sideways and then engulfed, and then now they're shifting down by the looks of it towards the.
So you will use classic price action analysis, so candlestick. So you look for engulfing, and then when it creates a lower low and goes through the low, then that would be your cue to take a position with it, or is it just?
Yeah, basically it's timings. So like this first hour, we get the high and the low, and then of course this pin is an anchor point, so we can take that, and if we're looking for a measured move, we can just put the measuring tool on there, and I'll usually look for twice the expansion. So this I'm targeting, if this is going to fit the bill here, we'd be targeting somewhere around 45 with the spread. And and again, timings as this gets into the 50 level, once we've cleared this pin low, we'd be wanting to go to break even. And as timings evolve, if this is struggling to get through that 50, well, then I just cut the trade at 50 or wherever we're able to get out. As time decays, this should move reasonably quick towards its target. But the longer it takes, the closer I am to cutting the trade if it hasn't hit the target.
Yeah. So especially
if it's hit 50 and started to come back or something like that.
Yes. Yeah, so just what's worked? You're in an environment now. Look, we set the same with Brexit. Now we're in an environment where it's going to be similar to what's happening in some US assets as well. Yeah, we're in headline territory now. So I think the market, and I'll show you some charts of implied volatility in a moment, because implied volatility, which gives me a sense of movement and an anticipated movement in a currency or an asset over a specific time frame through the options market. If I look at let's have a look at one week implied volatility now in G10. The pound. Hold on, let me just bring this up. The pound's trade got 11.2%, so it's the highest of any developed market or major currency, but it's not at extremities by any means. In fact, realised volatility and if you go into things like average true range as your sort of statistical realised vol, it's actually been very low in the pound. But if I look forward now, you are seeing the pound as the wild child of G10 again now. So you're looking at 11.2%. You compare that to the Aussie at 9.8%. So you compare that to euro dollar at 5.6%. So you're at a situation where the markets of all the G10 currencies are expecting the greatest movement up or down in the pound, and that's going to be driven by headlines. So we've got the European summit over the next couple of days. There's going to be headlines coming out there. So for someone like yourself, if you're looking at your charts, how much does that news flow matter to you? I mean, obviously that's going to be reflected in price, but you're entering a regime where those price movements can be quite scattered, they can be quite aggressive, they can move around, and you're beholden to those. And how does that affect you when you know that you're going into an environment where headlines are going to move price quite rapidly and liquidity could be more of an issue? Does that affect you? Does that concern you, or is just the strategy?
Yeah, of course. There obviously, I mean, the main four pairs that I follow are the pound Aussie, pound New Zealand, pound yen, and the pound. And of course, all four of those can certainly have surprises. The spreads can widen, they can wick. I mean, generally speaking, I almost expect the unexpected, because it seems that almost on a fairly regular occurrence around certain times into the London session, a couple hours in, without anything on the calendar, there tends to always be a surprise tweet or something about something that they've just negotiated or something that hasn't worked. So I am always very cautious. I think as we get closer to the date of them actually hammering things out, I will probably be very attentive to how much risk I'd be willing to put on. The problem is that the day, it's like BOE. Some days you go in there and you think that the last few times they wick out both sides, it's very similar to the Fed, and then of course on some occasions they just tap the high, and then all of a sudden they drop at 100 pips, and it's looks easy in retrospect, but you don't know. And I don't tend to like to get in front of the news, and obviously as they get into the meetings and when we had some of that stuff being worked out before they had the resettled date for is it October that's coming up.
It was supposed to be yesterday was the deadline, but they've pushed it up.
Yeah.
Boris Johnson saying after the European summit, so it'll probably be Monday if they haven't. I think there will be a deal personally, and
yeah, and I think that's generally, obviously they can't let things not get worked out, but I think one thing about the pound,
they get stuff done at the end, last minute. That happens every time.
I'm a bit of a cynic in that I think that they will use any excuse to spike both sides sometimes, and just I guess, clear the stops. They have justification for large orders coming in and whatnot, but I am very sensitive to those pairs pulling surprises. But I guess that's sort of the attraction, is that they do offer consistency in terms of their behavior that way. They move, they are volatile. When they do go, they go. And then the odd time, you know, I try not to be a cowboy. I mean, I've got a very sort of set routine, and that was designed on protecting me, knowing where, you know, my mistakes could be made. And so I guess the biggest thing is just not underestimating what can happen and making sure that we protect the downside.
Well, let's have a look at this chart now, because as I'm looking at the markets, and I think we've seen a bit of movement. The S&P futures are down about 1% last time I checked. So there's a bit of risk off coming out into the markets as we speak. So you're seeing the pound drop. Yeah, it's coming off a little bit. We're down about 60 pips in that session. So you're short in a position now. You've got through those lows. The thing that I think that retail traders find incredibly difficult, and professional traders do as well, let's say anyone who's not systematic, is getting the most out of a trade. For me, in a trade, I find it really easy to cut out of a trade. You know, they say, look, like winning trades take care of themselves. You're a manager of losing trades. I don't like them. I find it harder to go into the trade and extract the most out of a trade and let those profits run. As soon as I'm losing money, it feels like I've got to do something about it. I've got to go into damage limitation mode. It doesn't feel right. I want to cut out of that trade. I find it difficult to extract the most out of a trade. How do you go about this? What's your rule? I mean, you may have covered part of it, but you know, in terms of the getting them, you're in a position now. Let's say you're short. How do you go about extracting the most out of that move?
Well, generally, I set my targets right off the bat for 50 pips, and once I've set the target, part of that's because in the past I would get into every trade and expect they were going to go 500. I've been up some trades 700 pips and gotten nothing, and so years ago I had a mentor tell me his own experience. He worked on Wall Street for 40 years, and he told me the same thing. He said, learn to take a profit. And so I always preset, and partly the reason I preset for 50 is that in most cases when they move 50 pips, aside from a trending day, which is not, you know, a regular, it doesn't happen every day, they'll come back. And as you see even today, they're going back to get the guy who's in the money from yesterday. And I have a saying, I remind myself of this every day: nobody gets a free lunch. So even when you're up money, they come back, and part of their objective is to make sure that most people are disappointed. Most people hold on for too much, they get out too soon, all those things. And if I get 50 pips a day, my goal has always been to not so much get pips, but to develop trades that I was going to be able to scale up in size. And so I'm quite happy.
My question to you is, if you're going for a 50 pip straight off, and you know you've got different levels of volatility in the market. So if I'm seeing, you know, cable implied volatility at 18%, and I'll see, or historical volatility, whatever X, and then the next, a week later it's 5%. So obviously the movement is obviously a lot less. Would you not feel like you could have a little bit more leeway to set a slightly bigger profit target? You know, can that profit target be a function of volatility and movement in the market?
Yeah, like yesterday's a good example. Can you still see my screen, Chris?
Absolutely, yeah.
Okay, so you see I've used the measuring tool. When we get a day like yesterday, where we've got a day that went down right from the beginning. So again, Asia's consolidated sideways. London's putting in the low of the day, and I was in the pound Aussie, but I'll use the same strategy on that geometry for a mirror image measured move. So if we're targeting one expansion of this range rather than 50, we're now targeting possibly 75 or 100 pips. And again, as it progresses, so we've got the pin, which should become a flip zone. So this is kind of, your market profile, your double distribution day. Again, and I learned this from Peter Brandt. One of the biggest things I learned from Peter was that, you know, you want to target asymmetrical risk reward. And the whole idea behind this strategy, which, you know, everybody, I said this for years, oh yeah, well, I want to make 5 times my risk, but I didn't actually have a mechanical model that was in alignment with that. And what I learned from Peter was just, you know, classical charting. They target just rectangular geometry. And so when I get into a situation where we are in a trend day and they've, you know, they're making a very strong, fast move, I'll readjust that if I'm not already out of the trade. If it hasn't hit my target, as you see yesterday, that was a very fast stop hunt. But so they've hit targets, but then we see the continuation. And on the pound New Zealand, we had I'll just open this up. We had a nice, right before the US market opened, a nice big bullpen hammer just prior to the pre-market. And of course, it just moved, it just mirror imaged right on top of the breakout. So sorry, go ahead.
No, I was just going to say, when you've done this, send the screen back to me.
Oh yeah, how do I do that, Chris?
I'm not sure. But yeah, sorry, keep going.
Yeah, so I was just going to say, like, you know, the next thing is if I'm in this trade and I'm expecting this, you know, the hope emotion kicks in and I'm hoping this goes forever, but it gets into the New York Open and all of a sudden it starts to behave differently. Like in a strong move, this should just continue and not come back at all. So if we see any two-sided trading, I'm quite happy at any point to just cut the trade and say, okay, like, you know, as soon as it gets up past the 50 into the 75, like every time it hits a quarter level, I'll be readjusting my profit target so that I make sure I lock in at least the 50. And sometimes, you know, trailing, like, you know, I don't typically trail. And the reason why is that I know that within that move on a normal day, yesterday's not a normal day. It's a very fast, hard moving day. But on a normal day, they'll often pin down into the trade to get traders that are trailing the stops. So they get 20 instead of 40, or, you know, even towards the end, once it hits 40, if it spends more than 20 minutes at that 40 level, and we're, you know, we might be at the high of the day or the low of the day or at round numbers, I'll cut the trade at 40 because I know once they slow it down, they might come back even before they complete the move. And, you know, obviously you're up 40, next thing you know, you're up 15. So I'm very happy to lock in 40 rather than sit through another hour of stress and just get 15. You know, I've done all the things wrong in the past. I've really honed my rules based on knowing how, you know, we can behave. You know, it's different when you're not live and you're back testing and everything else, but I've tried to design everything knowing how I behave in live time and what I'm thinking, and you know, how the emotions kick in, and it's so easy to change tact. I usually write everything out right in front of me and I hardwire it because it's so easy to just change things in midstream.
Quick question then, before we move on, because I guess we do need to get into the US election, but quick question from Mike. What stop loss do you use, Stacey?
So whenever I'm in the trade, usually once I'm in the trade, it'll be that one bar, one ATR. If I'm in at numbers and I feel it, like, you know, usually with the pound yen, we're talking 15 to 20 pips. Obviously with pound New Zealand, pound Aussie, slightly different spread. It can be a bit wider. And obviously if there's been a big bar, again, like yesterday, that was a big bar, but I'll still hold my stop around that 20 pip level because usually when it's a hard moving market, they should not come back into that trade at all. It should continue to move very quickly, you know, 6-7 pips, maybe just fighting back and forth. But if it comes back further than that, then I'm wrong. And I'll often get out because, you know, when you're wrong, and I don't like letting it go all the way back, because when you're in a trade that's supposed to move quick and it doesn't, there's something wrong. I've either gotten in too early, whatever, but usually it's one bar, so you're talking 20 pips. And again, if you look at those number levels, the thesis behind that is that if it's gonna hold at that level, like if they lock it in at 50 or they, you know, do a 25 pip stop hunt down to 25 and they're gonna move it from 50 to double zeros, if I don't take that loss, I could be in the measured move the other way. So if I don't get out when I'm supposed to, that could be going 50 to 100 pips in the other direction. And with the pound crosses, it can easily do that.
Cool. Well, I've actually taken, there's a couple of people talking about, I've actually taken Stacey's screen. So we'll go off into some dollar moves in a minute. When we cover US election, maybe you can show that stop loss in reality.
Yeah, you've got the chart back, right, Chris?
I've got the chart back. I just wanted to say that I've got, it's, as a sort of a macro thinker, the way that I look at this is I'm looking at the big picture, and then I work my way into what's the flow of capital, positioning, and all those things. There's quite a lot of work involved in the process that I have, but at a very top level, the first thing I'm looking for now is how much political risk premiums in the pound. And if you look at the purple line here, I'm looking at inflation-adjusted bond yield spreads relative to US, and you can see there's been a strong correlation over the years. It's broken down a little bit now, but I think that's a large amount down to the political risk premium that's come back in there. So, but I think the pound is cheap. The pound is pricing in at a huge political premium. And that suggests to me that if we get a positive resolution, that political risk premium needs to come out. And I think the pound here at 129 is fundamentally cheap, and you have that risk premium that comes out. It's not, if we were to see the full mean reversion up to say 145, the pound is not going to get to 145. I know that if I look at the options market, there's an 11% chance that we're going to get to 130. I think 135 in the next month, but obviously that comes across the election. So I use this as my top-down framework. The next thing that I'll look at is obviously what is the flow of capital doing. At the moment, you can see here that we're in this kind of bullish channel, and it's trending. We've got this. If you look at the 5-day exponential moving average, it's moving up. Generally it's holding now. It's sort of become a bit more whippy now, but we're still at the moment sort of working within this channel. It looks like it's breaking down, but what I like to see is a situation where fundamentally I can see the currency is cheap, and we then see the flow of capital. And that's really what we're doing as currency traders. We are trading the aggregated flow of capital, whether that's investment banks, whether it's buy-side funds, pension funds, endowment funds, whatever. It's the aggregation of capital that you're trading at any one day. That's what you're doing, Stacey. You're trading capital flows that are going intraday. I mean, I'm just sort of doing it a little bit more long term. But my view now is the pound is cheap. That doesn't mean I'm going to blindly buy it, but we just know that there's a lot of political risk premium that comes into that. The next thing we're going to talk about. Go on, Stacey.
Sorry, I was just going to say, Zoran, we've got a couple of questions as well, guys. So perhaps maybe we can get each one of you to answer. So one of those questions is from Sia. How important is timing? So Stacey, do you want to touch on that very quickly? How important is timing when trading?
For me, it's that's probably the most important thing in terms of how I approach things, because I usually, if you go back and look at any of your charts, you'll often find that the high or the low of the session will be established in that first hour of each equities market, Asia, London, and New York. So the basis, as we saw today on the pound, they went up 3 bars. So again, 45 minutes up to round numbers, and all, I don't go into a lot of depth on this, but I will go to my 1-minute chart to see how it's handling in that third candle, if it is around numbers or if we're at the higher low, because obviously you'll see the same fractal behavior on the price action at that level. And the difference in terms of getting in better, it's not that dramatic, but I'm just now trying to fine tune that when I am trying to get in. But timing is everything to me. And again, even when I'm in, as you talked about earlier, Chris, if I'm in a profitable move, there's a time decay factor. So that trade should be moving, because the whole thesis is that when they've locked in a level, it will usually move quickly because they've got traders trapped in the wrong direction. And if it doesn't behave that way, my time decay kicks in pretty quick. Because again, 25 pips is one thing, but if it starts to slow down and consolidate at 25, then I could be the next target. So I'll be looking to cover that trade or go to, take profit, whatever. But timing for me in that 3-hour window, each hourly rotation, first and last candles, that sort of thing, the rolling over of the 1 minute, 15 minute, 1 hour, and 4 hour time frames is critical.
I think timing can be brought into a macro sense as well, and macro trading. I mean, for me, you know, I've got big picture ideas, and I'm sort of looking for the right asset to trade to express that view. You know, let's take the US election, for example. You know, there's different permutations, which we'll talk about in a moment. But I'm looking for the right asset to trade. And, you know, if I'm early to a trade and the flow of capital is doing the opposite of what I think it's going to do, I'm not going to take that trade. You know, I'm not bigger than the market. The market, you know, if I've gone the wrong way, I'm going to lose money. So I always wait for the you know, the big picture, your weeklies, your dailies, to show me that the market is warming to my view. The flow of capital is all warming into that view, and then we take it down into different time frames. But for me, that's a form of timing. I have a view. I have a view about what's going to happen. It's based on a sort of a you know, a different framework of looking at various charts. But what's most important is that as a short-term trader, as someone who's using CFDs and leverage, is that you've got to wait for that flow of capital to move in alignment and you hitch a ride with that. So when you've got agreement between the two, that timing is everything. And obviously, you know, working out my risk and my position size is obviously very key as well. So I think that covers that quite nicely. Let's go into the US election, because I think this is going to be really interesting. I was quite disappointed to find out that you were Canadian, Stacey, because I thought you would have a really strong view on it.
I lived in the States for 5 years, so that's kind of close enough, I guess.
Yeah, I think what's interesting, we'll go into the charts in a second, but you know, I think it's really important that we are coming into this major event on what effectively for us in Australia is going to be the 4th of November. But I put this basic model here just to show you a little bit about what's going to happen. Please do not take this as me having a political view. I put this out on Twitter and people are like, "Oh, you're a Biden fan." I'm not at all. This is just me coming out with what we can use. And yeah, everyone comes out and says, "Oh, look, 2016 was rubbish. So why do we look at this time around?" But I thought this was quite good because you know, there's a lot of interest now from clients in the US election and what's expected. So we put this out in some of my research, and just to set the scene for you as well, Stacey, in terms of what we're looking at for the president at the moment, 538 in terms of their Monte Carlo simulation, 40,000 simulations, has Biden winning 87% of the time. That's a lot higher than what it was in 2016. Super Forecast, which you can get from Good Judgment, has an 84% chance Biden wins. Real Clear, in terms of their no toss-up model, where they separate the toss-up states and actually give it, has 358. They need 270 seats in the electoral college system to win that one. So, yeah, the betting markets now, if you want to use that as a way, has a 66% chance that Biden wins. The House will go to the Democrats. That's pretty much done. They're not going to lose enough seats there. The Senate's probably the most interesting race for me. So at the moment, the Republicans hold 53 seats. There's 35 seats that are up for grab. 12 of them are owned by currently run by the Democrats, and 23 by the Republicans. So the question is will we get a majority for the Democrats? Will we see the Democrats who now have 47? They're going to lose Alabama, so they're going to have 46 seats to start with effectively. Will they pick up 4 seats to get this over the line? At the moment, the market's saying that they will. That to me is absolutely key now, because if these models are correct, and of course there's a lot of people in this room, I'm sure, saying, "Oh, you know, how do you predict all this stuff? It was terrible in 2016. Brexit polls were awful, and these various factors." But the margin of error here is so big that you'd have to be an absolute calamity for this to be wrong. But the model at the moment, this isn't really my model, but the aggregation of all these various variables suggests that we are going to see what they call a blue wave. They put that at 58%. So that's Biden getting the White House, the House, and also the Senate, and that has massive implications for them to be able to pass policy. Of course, you know, these things can be wrong. I'm not a Biden supporter. I'm not a Trump supporter. This is just me being guided through this situation. So I do think you've got to have a look at the Senate. If Biden wins the White House and has the ability to pass his legislation, and we don't have that gridlock, then that's going to have big implications for markets going forward. Stacey, before we go into some of the charts that we're seeing at the moment, have you got any color? You know, what's your feel about the election, and how do you think that's going to sort of play out into markets?
Well, generally speaking, you know, I don't have the data that you've compiled, but I have a lot of contacts in the States, and I think the underlying tone is, as much as people may not admit it in the open, there is a theme, an underlying theme where they will support Trump. I think he will get reelected. I think that will be good for the markets in terms of stability. I think if Biden gets elected, I think we'll have a lot of volatility because there's uncertainty until obviously there's some clarity in terms of which direction he'll head. I think if Trump is reelected, we'll see some strong trends develop probably in a few of the currency pairs, the pound especially, obviously with Brexit and that. I think that would create, you know, again, you know, coming back to timings, I look at the monthly rollovers for timings as well in terms of, you know, them rolling the book and continuing or reversing trends. And I think that we can see some very strong moves, especially if Trump is reelected, because I think that as much as he may create a, you know, a polarity between the public, I think right now things are, with COVID and everything else, there's a consistency there, and the markets have, you know, how do you explain what's happened? Not to say that their policies have supported all that, but obviously there's confidence in terms of things continuing forward. And if COVID gets, you know, they get all that sorted out, I think we could see some continuations of some big moves. So, which for us, even on short term, I think, you know, I want to trade with the trend.
Well, I think the first thing, this is the most important question, first of all, before we break it down. So what I've got is a chart here, and what I look at is the first debate. I think this is absolutely, this is so important to markets. And that's the level of hedging that's gone in around the election. So what I've done is I've pulled out, can you see this chart all right, Stacey?
Yep, yeah, perfect.
So this white line here is the different contracts, the different expiries for 25 Delta S&P put options. And the red line there is call options. So obviously give you the right to buy. You know, so you're basically looking at the implied volatility, the expected movement in the input options. And what you can see here is that they're quite high in put options. And we're looking at puts because this is how a lot of the institutional funds will protect themselves. A lot of the institutional funds don't want to go to cash. If there's volatility and there's big pickup in volatility, the funds don't want to go to cash. They have these incredibly sophisticated consultants who come in and do this, you know, volatility overriding systems as to make sure that if there is a big move, that they're protected and actually can benefit from that, so that, you know, they don't have to sell their core holdings in different positions, but they just have these option structures that are in place. And that's what I look at. It gives a really good insight into this. So what you've got is, you can see that this red line here, this red dot, is the 4th of November. So what we can see is that put volatility is incredibly more expensive than call volatility. That tells me that demand for puts is radically more expensive and much higher into the election than what we're seeing for people looking for betting for upside. Okay, so at 27%, that's pretty high, and certainly a massive gap relative to the demand for call volatility. Now, what's really important here, Stacey, is that the expected movement and the implied volatility, the cost to buy put options, actually increases as we go further out into December. So you can see the election here, and you can actually see we're actually about 1.5 volatility is higher. So what does that tell me? It tells me that the market is hedged for a contested election. So the first question that we should be asking is not who's going to win, it's whether or not someone's going to accept it. Is it going to be taken to the Supreme Court? Because what we can see is that people are hedged. And I believe, and this is not a consensus view, is that we can have a rally regardless of who wins, just because the market is hedged for an ugly contested election. I mean, we heard it in the first debate, where Trump effectively wouldn't agree to, you know, so if there's irregularities with the voting system, You know, he talked about the Proud Boys and other factors there, and Biden's in a similar-ish kind of camp. But if we don't see it being accepted, if Biden wins convincingly, I'm not saying it's going to happen, but that's what some people are suggesting, and Trump does not accept it and then takes it to the Supreme Court, this is what this roadmap in the options market is now telling me, that the people are hedged for that. And if we do see Trump accepting a loss, then I think that you're going to see all this hedging coming out of the market, unwinding very, very quickly. And that could be a relief rally. Markets hate uncertainty. So if we get a result, and that might not come on the day because there's a lot of mail-in votes, it might take a day or two to come through. I don't think it's going to take weeks like some people have suggested. But if we get a result, that may just be enough to reduce the fact we actually have certainty, and it's not going to go to anarchy in the streets and carnage. We actually have a result. Now, is that going to be Trump in the White House, Biden, we're going to get a split Congress? Who knows? I think just this chart tells me that there's so much hedging in the market that an outcome that gives us certainty, that businesses can say, we now know how to invest in the long haul. And then you might get a relief rally very shortly before people sell into that because of this level of hedging that's come through. Of course, if we do see a situation where it's contested, which the market's telling you is a very high likely probability, then that could get ugly, and you could see a situation where you know, equities suffer and risk assets do poorly. The US dollar will go bid in that scenario as well. So I think that's the first question you've got to ask. Are we going to see an accepted outcome, or are we going to see this being contested? This tells me the market's position for contested. So we could see relief either way. My view, I actually take the opposite side of view. I think that Biden, if he gets a clean sweep of all three chambers, has promised you know, massive fiscal spending, deficit spending, which will be incredibly expansionary, and they'll be able to pass that. Now, of course, he's going to fund that with a higher corporate tax, 28%. There may be some issues with him taking on tech, but if I look at the chart, Stacey, then I'm going to pass this back over to you just to get your sense. But if I have a look at, you know, people have said to me, "Oh, Chris, you know, Biden's going to take on big tech," but we've known that for a while, right? And if I have a look at this, I'm going to bring over this chart now. Just give me a second. If I have a look at this chart here, which is the ratio. Sorry. Okay, so what I've done is I've looked at the S&P relative to the S&P tech sector. Okay. So you can see here that the tech sector is outperforming the S&P. You know, we've looked at it as a ratio. So I like to do long short strategies, pairs trading quite a lot. And you know, one way to look at that is through ratio analysis. And everyone says, "Oh, tech's going to get smashed." Well, we've known that, you know, the markets have been suggesting Biden was going to win for a while, but yet tech continues to outperform. It doesn't suggest that the market's really that worried about this going forward. So are we going to see tech getting destroyed if Biden comes in and takes on, given what he's been talking about, antitrust? Doesn't seem like that's going to be the case to me. Well, have you got any thoughts around that, Stacey, at all?
Well, again, I think if Biden gets elected, he would be to come in and all of a sudden, you know, make radical change or to take on something like that. It's one thing to verbalize it, but I think he's gonna, in terms of an action step, he'll probably rethink that, because after everything that's happened, if it's been, you know, obviously performing strong, and you want to keep the strong sectors performing strong, and then maybe over time introduce discussions or talks that they could look at how they can restructure it, that sort of thing. But I think it would be wrong for him to come in right away and all of a sudden start to do things, especially after all the unsettled timing of everything that, you know, basically the States is still not out of the woods. And again, the election, I think it would be an unpopular move for him to come in and do that, especially for people, the FANG sector. They're fascinated with all these tech stocks, regardless of what kind of company they are. I think America, it's like anywhere. If the markets are performing and giving people opportunities, then, I forget the stats, but there's only been a couple of presidents that haven't been elected after a bull market. And for the most part, every president that's, been in an office first term in a bull market gets reelected. So obviously we haven't been in a bull market, but we've seen some absolutely phenomenal moves coming out of March. A lot of companies have doubled and tripled, and in Australia, obviously, even more. But, again, first term president, I think it would be wrong for him to all of a sudden come in and start, breaking the party up. So he's not a Donald Trump. I mean, Trump people expected that. And I still think that as much as people are, there's a dichotomy there, excuse me. But I think at the same time, as you said, there's certainty right now knowing what Trump is about and what he's doing, and there's consistency there. And I'll be surprised if he's not reelected, even though the data doesn't support that. So.
Mm-hmm.
Can I just say something? Sorry to interrupt, guys, but we do have a question from one of the one of the attendees. Leandro is asking question for Stacey. What's your trigger to enter a trade? You wait for the low or the high of the first hour session to be taken? Question mark.
Yeah. So what happens typically is, and again, there's a template. So we're looking at the high and low of the week, the high and low of the day, and the timings. So Asia will typically, there'll be a high and a low in the session unless they, blow it out by 50 pips and take out the high of the week or the low of the week. They'll go into consolidation in that first hour prior to the equities open. So we're talking 2 a.m. New York, 2 a.m. to 3 a.m. will often be a move that initiates the expansion of the range. So they may take out the high or take out the low. As we saw today in the pound, they broke through the low and continued down to double zeros. They went through the double zeros, and then at the open of the equities, put a pin there and worked it back up into the double zeros over the 45 minutes and rolled it over. I'm looking for an engulfment or a pin hammer in line with the high or low of that equities hour. So if I get that trigger, now often, we're looking at the low of the day, but we're looking at a measured move now of that Asian range. So that was a 25 pip box. We're looking at a 50 pip target from that breakout of the Asian range. Basically high engulfment and pin hammer at the extreme. So if you're trading with the trend, you're trading the break of that range. If you're trading against the trend, you're trading at the top or the bottom of that range.
Stacey, can you put the chart onto euro dollar or the dollar index USDX? There's a question here about the dollar, and my view is if Biden comes in, I think that's going to be a dollar negative. I think the idea of adding $3.5 trillion to the deficit, I think, is fundamentally negative. The fact that everyone knows that is the market's short the dollar.
See that okay, Chris?
I can, yeah. In terms of your setup, I mean, I think that if you're going to get that, you're going to get rising inflation expectations. I think real yields will go low. I think that's going to be bad for the dollar. I think that's going to cause yields to move higher in terms of nominal yields. And I think the Fed are going to have to step in and do something about that. That will be more QE, probably yield curve control. And again, that's just going to mean the Fed's balance sheet goes higher. So I think a Biden win would be dollar negative. But then the thing that worries me is that's a massive consensus trade now. So I think that would really be the issue, and even other central banks have mentioned that along those lines as well. So I think the Biden presidency would be a big dollar negative over time. But in terms of what you're seeing here and how your system, what's the flow of capital telling you about the situation right here, Stacey, and also
okay. So if I look at just on the monthly cycle, so we're looking at the daily chart. As I mentioned earlier, I will look at the monthly cycle and typically the halfway point. So in terms of timings, we'll see the very similar setups because everything works off the highs and lows, and as this market heads into the election, you know, gold as well, I'll be monitoring how we handle. We're down, obviously down low, but when we look to the weekly chart, we still have downside here. But on the daily chart, we're in a consolidation near the lows. So we have a rectangle that's formed. They've broken out of the high. So this is no different to me than looking at a 15-minute chart or an hourly chart. They've broken out of the upside. This is a narrow range consolidation over 2 months. And as we head into the end of the month, if they come out of this and they come through the high again, we could again be targeting a geometrical sort of expansion. So similar to anything like the Monday to Friday cycle, if I get a Monday, Tuesday like this and they're reversing it for the week, we could be looking at a nice rally back up, you know, up above this middle structure again. And again, that's if we see this consolidate and start breaking out of that high. If we're going to go to the downside, obviously that would roll over and retest without taking out the high, and we'd have the same measured move opportunity on the downside if we just readjust this from high to low.
Just for anyone who's not understanding what the USDX is, it's the US dollar basket. So it's a range of currencies that are traded against the dollar and packaged as a basket. So 57% weighting is euro. There's some yen in there. There's some Swissy, and I think a little bit of Swedish krona. I can't remember exactly, but it's 57% and a bit of pound as well. So if that's going up, it means the dollar's strengthening against those basket currencies. If it's going down, it means
one
the
thing
dollar's
that's
weakening.
obvious here. Sorry, Chris. I'm just going to say one thing that's obvious is that we do have 3 pushes into this consolidation at the bottom. So, you know, this could certainly we could see a squeeze sort of develop, and that, you know, if this does consolidate and reverse, we could see a very strong move. You know, not to say that this will happen, but there's obviously lots of room to retest where that whole move began. But, you know, there's, I don't predict, I just try to respond in terms of how price behaves. But as we see this consolidation, they've made the early break and now they're coming back inside. And as we head into the election, obviously we could see some volatility. But if they come back through that upside, we could see that certainly move up and retest.
In terms of timing, so you've got, you know, this has been going on since mid-June, mid-July. The longer that you see that consolidation, the more powerful when it does break out that
exactly
trend can be, right? So this is something that must be looking quite exciting to you right now.
Well, you know, again, this is my Monday to Friday sort of scenario. I call it the day zero. If I get a consolidation of Friday, Monday, Tuesday, in, you know, 80% of the case, we'll usually establish a high or a low. You can get a 3-day cycle, Monday, Tuesday, Wednesday, working up into the high or the low of Monday, Tuesday. You know, if we flip back and, you know, just look at the pound, we'll just zoom in. This pink line is the Friday, Monday divider, and you can see the same sort of scenario that we had happen Monday, Tuesday. We had the nice big rectangle. They compressed the range. We get the Monday's high taken out in the US session, but that big rectangular structure, which again is just a 75 pip box, when they come out of that, that's often what you'll see when the weeks reverse, and you know, you see 1 week go up and then the next week it goes down, or you'll see 2 weeks of trend. There'll often be a consolidation of a couple of days in that Friday to Tuesday or Monday to Wednesday cycle. And the same sort of scenario plays out. I mean, I learned from Peter Brandt, and you know, he uses weekly charts, and his whole thesis, and he said something to me one time and I've never forgot it. He said, when these trades go, when they break out, as we saw on Tuesday, the whole premise is that they don't come back because they're explosive moves, and that's built up over a coil. And so, as I was saying, if something hesitates and doesn't respond properly, I know that there's something wrong. But when these trades go, they just go, and there's no stress. And, you know, similar with that USDX, if this thing consolidates and there is a big move, it'll be fast. It'll be fast, and you know, again, it could certainly break out to the downside depending on how this builds up. But if we do see that retest, and you know, the initial break has been to the upside. So if this coils and comes out, we could see a big move back up fast.
Yeah. Yeah, I think medium term, I think the dollar's going lower, but I think what could be interesting if we do see a Biden win at those, then if the bond market sells off, that would be very positive for the dollar. What would then be the trigger would be then the Fed coming in and curbing those yields higher. They can't have yields going higher. They'd have to do something about it. And I think what would then be, that would then turn out to be a dollar negative, which I've written about quite extensively. But there's one question on sterling Aussie. Okay, can you bring up a chart of sterling Aussie and just have a quick focus on that?
Yep.
Also, Chris, do you want to answer the question about gold and oil? I know you actually talk a lot about it. So in the meantime, if you also want to comment on that. So
well, gold's a play on the dollar. So you know, if we get a I mean, I think fundamentally, if Biden comes in and you're going to blow up the deficit, fundamentally that's just a fantastic catalyst to be long gold. But I think what you need to see is a weaker dollar in that situation. So if the Fed can come in and curb yields by buying longer term bonds, you know, increase the duration of the bond buying they're doing through QE, if they can fix the curve through yield curve control, then I think that's gold's just going to be a fantastic hedge. It's probably a hedge against the madness that's going on in central bank policy and experiments. But right now, you know, if you are going, it really depends. You know, Stacey showed a great chart of the dollar going sideways. If the dollar starts forward, if the dollar rallies initially, which I suspect could happen if we see a sell-off in the bond market, then gold's going lower. But then I think tactically you will get that switch once the Feds start coming in and trying to curb yields from rising, and then what we'll see is inflation-adjusted bond yields moving sharply lower. I think then gold's going to go sharply higher on the back of that. So it really depends on what happens. You've got to look at the bond market. I'm all about the bond market because currencies work, you know, very closely to what's happening in rates and also in fixed income. You know, it's where the capital flows to where you get yield effectively. So I think, you know, I watch the bond market very closely. If bond yields go up post the election, the dollar's going higher and gold's going lower, and obviously the opposite is true in that situation. But yeah, I think longer term, I can, which is not what we do as CFD traders, right? You know, longer term, my view very much and my framework suggests that we are going to get a higher gold price, but there's obviously a story that needs to be told to get there.
Thank you.
So sterling Aussie, what are you making of that? You've got 15, but can you go out to a slightly larger time frame?
Yeah, absolutely. We'll go to the daily. I'll just bring this out blank. So obviously long-term chart, daily chart anyways, not so much long-term, but the last few months, we can see that we've got the peak formation up here. We're starting to work the bottom. They're working the low. I always look at everything like a box. We got the high of the box up here. They had the low of the box down here. They brought it lower. So we've got our peak formation down here. And again, the rounding bottom formation possibly happening, maybe even a bit of a pseudo head and shoulders formation. And obviously a similar, if this was to, I mean, I think the upside on the pound pairs is all huge potential. Again, if we go out to the monthly, right now, still, you know, they've broken this sort of channel, but they're working the low. We've had that second hit down and no follow through. When we look at the daily again and just see this, they've worked the low. So when I you know, if we're talking about a box, they're working the bottom of the box right now. And if they've locked that in, if that is the bottom, and they do come out of this range, then obviously there's not a whole lot. You know, we've got a couple of levels where they've pulled back and broken through, but there's not a lot to slow this down if it comes back through here. This is all one big fall, and there's not a lot of you know, trading that's going to halt that in terms of significant levels. We've got a breakthrough at 2 levels. So I'll just drag this down. And Oh, maybe not. And, you know, if they clear these levels, again, I look at everything in terms of stops. You know, there's money or technical levels, institutional levels. If they clear those, again, similar to what you were saying, there's no problem for an institution to flip and take the other side and be heading in the other direction pretty quick, especially if that's where the flow's going. So, you know, we've got a bit of a W formation and a smaller pattern within a pattern. And obviously, again, geometry, just looking at measured moves, we could see, you know, even just coming out of here, that this has got potential to get up to that first level pretty quick if it breaks this ceiling. So I think, again, I am biased to the long side on these pairs, but obviously day to day, I'm going in whatever direction that my trade setups give me, because you know, if I get 50 pips down, 50 pips up, I don't really care. But if it starts to trend, then obviously the path of least resistance is hopefully going to be the easier way to trade.
Have a look at Euro Aussie, because that's a really interesting one as well for me. It's just been boring as all hell for a while. If you have, it's just there midway. So if you have a look at the chart, you can see it's just consolidating.
Oh yeah.
You're into
Yeah,
moving
again,
averages.
similar. It's come down, and we got a nice, again, that sideways consolidation.
Yeah, this is one that I've been trying to say. You know, when this breaks, this is going to trend, because it's
yeah,
just
absolutely.
been doing that. It's getting to the top end of the range. You've got the 200-day moving average pretty much capping the gains as well if you're into moving averages. But this is one that I've just said, when this goes, it's going to go. But now we've had months of it just moving in this range. It's a range trader's paradise. So obviously, you know, we'd be looking to sell into the top end of that range and then flip that. For me, I'm looking at that and I'm going, well, you know, I don't really like the euro. I'm not a massive fan of the Aussie, although I think if we do see reflation coming under Biden, the Australian dollar is going to be a massive beneficiary of that. So I think hard assets are going to work well. But at the moment, that chart is telling me, the probability is you start looking at short positions into that and then flip it if you get a weekly close through the top end of that range. So this is one that I've got on. I'm not doing anything weird. I've got it on a high watch radar, but I'll be looking at shorts into the top end of that range with an idea to square and reverse if it actually can close through there. Because I think the close through that range could actually be very, very significant indeed, and we'd see the pair start trending as well. So I think that'd be one I'll be looking at.
So yeah, a good chart, because you know, the big moves come out of consolidations, and that's a fairly solid pattern right now, even that smaller pattern within the pattern. And certainly, obviously, timing wise, as we head in towards the end of the month, you know, we could see this start to obviously build up some energy for a big move. Similar to the pound Aussie, there's not a lot to stop this if it clears these lower levels, because again, there's a big gap and this could move up very quickly.
Cool. I got a question from Ian. Do either of you think the Bank of England will go to negative rates in the UK? Well, I think there's a reasonable chance, to be honest. That said, I don't think it's going to happen for a while. I think there will be rate cuts probably in not this year. What's more important, though, for me is what the market's pricing in, Ian. And if I can't show my screen right now, but if I have a look at the swaps curve and have a look at interest rate markets pricing for certain dates, I'll tell you that in the next couple of years that the market is pricing in negative rates. In fact, you can just have a look at 2-year gilts, 2-year UK bonds, which are trading at a negative yield, and that will tell you that the market's pricing in that they're going to go to a negative structure. When you're talking about negative, have a look at New Zealand. They're arguably the most aggressive. They're talking very openly about working with the banks about negative rates. They're not, so I think we're probably likely to see them going first. But there's a pretty good chance we'll see the Bank of England adopt a slight negative bias here, but it's not going to happen for a long time, and it will really depend on the fallout from what happens in the Brexit, whether we get a free trade agreement of some sorts, and what that means for the economy going forward, and of course COVID as well. But the market's pricing in a small element. But the trough is negative 5 basis points. The market's pricing in a little bit of negativity playing through.
Cool. Okay. Well, looks like we've actually slightly over time, guys. But yeah, I would just like to thank everyone for attending the webinar tonight, and especially thank you to you, Stacey, for being a guest. Also, thank you very much, Chris, for taking your own time as well to be here tonight. So, if you do have any questions, obviously for those that actually signed up once again through Stacey's Stacey's YouTube link, please feel free to reply back to him and ask any questions. Also for those existing clients as well, feel free to get in touch if you have any questions. Trading forex markets with us, or CFDs or commodities, obviously you can take the full advantage of going long and short. So ahead of these volatile times, it could be something that you might want to do. If you do, please get in touch with us. We're more than happy to help you out and assist you as much as we can.
Cool. Yeah, I just want to say, really interesting strategies there from Stacey. If you haven't seen his YouTube channel, do go and check it out. There's a whole heap of really good content. But I will say, if you are looking to trade the election, my advice is probably the easy money is made going into these big massive events, and then actually after. The idea of trading in that window on the 4th of November, 3rd for those in the US, obviously, it's going to be tough. I tend to reduce my positions. I tend to actually stay out of those kind of situations, because you are fighting headline after headline around what states are doing, what that means, the perception. And then, even if you get the right candidate, is the market reaction going to be anywhere near what you expected? If you go back to 2016, there wasn't a lot of people who were predicting Trump would win. There were people who did. But if he won, the world was supposed to collapse and he was going to start wars with everyone. Well, we actually saw S&P futures going limit down. They were correct. But as soon as he started speaking, going through Trumpflation, we saw one of the biggest rallies we've seen for a long time. Bonds sold off, equities rallied significantly, and no one had predicted that, or very few people predicted that. So I think, you may get the right candidate, you may get the pick of Congress, but I think, you're fighting liquidity issues, you're fighting stops, limits, everything going off, you're fighting headlines. It's a very, very tough one to trade. I always find the easy money is made going into an election, as everyone thinks as a unit, and then when you get the outcome and the understanding around what's happening there. So I think trading in that window it can be very difficult to do so, as we're seeing also sometimes with Brexit as well. But so yeah, if you are trading it, just be obviously very cognizant of your position sizing, the volatility around that. Make sure you understand your risks, and do get out of trades if they're wrong. Don't hold them blindly and take a loss. I think it's my advice. You got anything else there to say, Stacey, in terms of your multi-years of trading?
Well, first of all, just say thanks, obviously, to both yourself and Zorn and Pepperstone for having me on. Again, you guys have been fantastic. You treat me extremely well, and I appreciate that. Echoing what you said, Chris, there are plenty of good trades Monday to Friday. Obviously, you're not going to get every single one, but you don't need to. There are plenty of really good trades without exposing yourself to unnecessary risk. I think I can tell you from experience, making tons of mistakes. Do things right, do things consistently and safely in terms of acting in your own best interest, and stay in the game long term and just keep getting better. If you're trying to catch the volatility and chase stuff because you want a quick fix, it doesn't tend to end well, and it's an easy way to do significant damage. So, again, keep it simple, focus on the long term. The election's going to come and go, and there's going to be plenty of great trades. Stick around and stay in the game.
It's exciting, and I love politics and how it connects with markets. But I can say there's a lot of other questions that we haven't covered. If you've got questions specifically for Stacey, get in touch with him. I'm sure Stacey, I'm speaking on setting him up, but I'm sure Stacey will be very happy to fill you in. If you've got any questions around Pepperstone or trading election or any kind of macro related stuff, the research we're putting out, you can get in touch with me on Twitter, Chris Weston _PF, or get in touch with the guys here, and we'll put you on the distribution for daily research around what's happening as well. But if you've got any questions, do reach out. We're obviously very happy to ask, and there's a lot more to go. But thanks for all you guys giving up your time today. We really appreciate that, and we hope that if you do trade the election, if you do trade Brexit, that you trade it safely with discipline, and we hope you make some money as well. So good luck.